Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg and Jayaram Krishnamurthy. And folks, we have quite an interesting week set up with good amount of macroeconomic data releases for this week, and almost all major economies involved in it, be it India, US, UK, or Europe. Although Asia Pacific will have a shortened week for a lot of the nations involved over here because of the Lunar New Year holiday, but we still have the Indian CPI today and the US CPI tomorrow. JK, I'd like to know from you what should we be expecting out of these inflation updates and how to move around currencies this week.
Good morning, Shikhar. Yes, CPI becomes a focus now after last week's anticipated changes in the CPI annual revisions due to seasonal factors did not really matter much for the markets. And even though some revision was there, downward revision in the December CPI number, overall for the quarter, the number remained unchanged, and but that actually led to markets not really reacting much to it. So, and overall, it was a very quiet day in terms of economic data, apart from some statements from the policymakers from either side, who continue to take a stand, in contrast to the market expectations. So overall, if you see, it has been a very quiet period for the currency markets also in the new year, and we are almost into the second half of the second month in the year. And this is because on the one side, we have risk assets which are trading at record highs and look stretched in valuations somewhat, driven more by liquidity. On the other side, we have a market that has assumed and discounted big rate cuts starting early, while more and more evidence and central bank statements are not supporting it. Hence, the currency traders are really not seeing an impetus for a large move either side, and we really need to wait through this period until something happens either from the economy or markets or on the policy side. So what we have is the stock market that hit a new high for S&P 500. Key level of 5,000 was broken as strong earnings and economic news was discounted. In fact, Nasdaq also traded above the 16,000 mark. Stocks have been taking cues from strong corporate earnings, inflation that is moderating somewhat slowly recently, policy rate that is definitely going to be down after this. The peak has been seen, and the economic growth that has actually surprised to the upside. All these things are keeping the markets elevated, although people do voice some concerns about the valuations of one-way rally. Possibly technicals indicate pullback in the markets, but even that requires some trigger, and that is missing, and we don't have too much data also right now. We also had some move up in the oil prices after Israel rejected the Hamas offer of ceasefire, and they continue to attack on the Gaza Strip. So Brent crude and the WTI both went up nearly 1%. And that's actually, but overall, if you see, oil has also been ranging for Brent between 76 and 82, and we are now at the higher end of the range. So that again is not such a big factor. On the other side, Euro and GBP, they have held well above 1.0720 and 1.26 respectively. This is also supported because of yields moving up in these countries also, in Europe as well as in UK. Yields have moved into a new 2-month high. And while we are focused on US yields, but these differentials being maintained at narrow level is also helping these currencies on the stronger side, I would say, relatively, despite all the talk about the US dollar getting more strength. So the correction in the US dollar from the lower side, which had started, may have run its course. Of course, we need to wait for some more evidence, either the inflation slowing or a rate cut or economy from the US. But we do have these yields indicating higher levels for these currencies. And also, there are some signs that these economies are also starting to bottom out. Last week's industrial production data from Germany was industrial orders rather was very strong in Germany said, and Germany has been one of the laggards as far as the Eurozone economy is concerned. And this week we have huge amount of macro data from UK, and that's very crucial. We have industrial production, then we have a GDP, unemployment, and the crucial CPI number as well. The whole week is complete with the UK data. Europe side, we have the GDP numbers and the survey on the business sentiment from ZOO. These are crucial. From US, we have only the CPI number, which is important, and of course, it will be followed by industrial production. So overall, we have a busier week this week in terms of economic events and data compared to last week, but we still do not see a bigger trigger for the currency market unless we see something moving out of line. Headline CPI for US is expected to be flat on month, but on year, it's expected to drop. Again, on the core, month is expected to be flat, and the year is expected to moderate somewhat. So these are the factors that we are looking forward to for the week. Then Chinese one, of course, markets being on a long holiday, it's trading closer to its weakest levels, but I'm sure if there is a tendency to weaken more, offshore banks from China will be active, as we have seen last year also in a similar situation. Yen is the only one which has seen some movement last week, moving from below 148 to 149.5, but that is also stalling now, perhaps ahead of the CPI number tomorrow. For the rupee, not surprising that we are again slipping back into a very narrow range of 5 to 10 paisa. Interest on both sides being strong. Foray below 82.90 was quickly turned around by buying from state-run banks last week, and now it is settled above 83 levels. Looking forward to the flows, in fact, because the flow side we are seeing there has been large outflows for stocks from FIs, but there have been even larger inflows for bonds from the FIs, and who are not so, who are quite underpositioned as far as Indian bond market is concerned. I just saw that, right from 2000 to 2023, we still had a large net outflow of foreign exchange as far as the bond market is concerned. So now that the yields are coming down, rate trajectory is down, and we have the bond inclusions in the global bond index. I think this year we will not be surprised to see a record inflow for the bond market. Stock market, of course, remains a question mark. So all in all, quiet period in the short term, but there's a lot to look forward to in the coming months. Thank you.
Okay, JK, that was really good. And yes, folks, the flows picture for Indian markets is kind of mixed because equity outflows have continued in the month of Jan, but at the same time, bond inflows have seen some life again. And as JK mentioned, there's a possibility of record inflows in the bond market to be expected for this year. Having said that, as of now, with so many macroeconomic updates in the lineup for US, UK, and Europe, as well as India, yet the market seem to be a bit on the sideways track as long as there's no bigger trigger which is visible in the market, or no bigger trigger is seen in the market. And this is also, in sync with the way markets have been acting. I mean, we've seen the key levels for US stock indices being breaking, but yet no correction as the market participants have been anticipating. The stretched valuations is on the one side, and the rate cut expectations are being discounted on the other side. Although, as JK mentioned, there is good possibility that US dollar correction have been running its course, and the possible or the potential move on the upside for yield is indicating the same. Recovery signs have been visible for the macroeconomic updates from Euro and UK, and we can further see how things go about with the releases in this week. So that's that for today, folks. We shall come back again with another round of updates tomorrow. Thank you so much for listening.